If I had invested just $5 a day starting at 18, I would have significantly more wealth today than people earning six-figure salaries who started in their 30s. That statement sounds like a marketing gimmick or some late-night infomercial, but it is a mathematical certainty. Most people spend their entire lives working for money, but they never learn the simple investing strategy that makes money work for them. When you look at a compound growth chart, the curve stays flat for a long time before it suddenly shoots up like a rocket. Most people quit during the flat part. They look at their younger selves, realize they spent their extra cash on coffee or clothes, and then spend their middle-aged years stressing about retirement and bills. The crazy part about building real wealth is that the strategy is unbelievably simple. It requires no day trading, no crypto gambling, and absolutely no finance degree. In fact, the more complex you make it, the less money you usually end up with. I spent years overcomplicating this. I watched the self-proclaimed gurus on social media, tried chasing the latest trends, and sat on the sidelines waiting for the perfect moment to enter the market. I missed out on years of compounding because I thought I needed to be a genius to succeed. Most people think investing is about being smarter than everyone else, but it's actually about being more disciplined. By the end of this video, you will know the exact beginner investing system I would use if I had to restart from zero today. We are going to strip away the jargon and the fear. Whether you are 18 or 50, the principles do not change. I learned the hard way that waiting for the perfect time is a trap. Most people think they need thousands of dollars to start, or they fear losing everything in a market crash. These fears keep you broke while the clock keeps ticking. There is a big lie in the financial world that needs to be destroyed. Most people believe that investing is about picking winning stocks. They think they need to find the next Apple, Tesla, or Bitcoin before anyone else does. This mindset is exactly why most retail investors fail. When you try to pick individual stocks, you are making emotional decisions based on news headlines and hype. You buy when things are expensive because of the fear of missing out, and you panic sell when prices drop. Trying to pick the right stocks is like trying to predict which specific raindrop will hit the ground first during a thunderstorm. It is a guessing game, and the house always wins. The average investor who tries to time the market consistently underperforms compared to a simple long-term investor who does almost nothing. Here's the part nobody tells you. The actual strategy for building wealth is almost boring, and that is exactly why it works. The core of this simple investing strategy revolves around three pillars: low-cost index funds, consistent investing, and long-term holding. To understand this, we have to talk about buying the whole market. Instead of trying to find one winning company, you buy a piece of every major company at once. This is what an index fund does. When you invest in an S&P 500 index fund, you are essentially betting on the 500 largest companies in the United States. If one company fails, it gets replaced by another rising star. You don't have to be right about one business. You just have to be right about the fact that the economy, over time, tends to grow. This is how you build wealth without the stress of watching individual stock tickers. The second step is to invest automatically. You cannot rely on your willpower to save and invest every month. Life gets in the way. Bills come up, or you see something you want to buy. The secret to success is taking the decision out of your own hands. You set up a recurring transfer from your bank to your brokerage account. Whether the market is up, down, or sideways, you buy. This is called dollar cost averaging. When prices are high, your money buys fewer shares. When prices are low, your money buys more shares. Over time, this averages out your cost and removes the need to time the market. Consistency beats timing every single time. The third step is the hardest for most people. Ignore the short-term noise. Market crashes are going to happen. They are a feature of the system, not a bug. History shows that the market has a 100% recovery rate from every single crash it has ever had. Long-term investors win because they stay in the game when everyone else is running for the exits. This is where it gets powerful. When you stop looking at the daily fluctuations and start looking at decades, the risk of the stock market begins to look very different. Most people quit right before the compounding effect starts to turn their small contributions into a fortune. To truly understand why you need to start today, we have to look at the power of starting early. This is where the math gets haunting. Let's compare person A and person B. Person A starts investing at 18. They put away a modest amount every month and stop entirely at age 30. They never add another penny for the rest of their life. Person B waits until they are 30 to start. They invest the exact same monthly amount as person A, but they keep doing it every single month until they are 65. Even though person B invested for 35 years and person A only invested for 12. Person A will almost always end up with more money. This honestly made me sick when I first realized it. You don't need to be rich early, you just need to start early. Time is the heavy lifter in the equation of wealth. The more time you give your money to grow, the less work you have to do. But even with this knowledge, beginners make the same mistakes over and over. Mistake number 1 is waiting for the perfect market. There is no perfect market. The best time to invest was 10 years ago. The second best time is today. Mistake number 2 is investing emotionally. If you find yourself checking your portfolio every hour, you aren't an investor, you're a gambler. Mistake number 3 is taking advice from social media hype. If someone is shouting about a moonshot or a hidden gem, they are likely looking for exit liquidity, not trying to help you build a beginner investing system. Mistake number 4 is quitting during a crash. A market drop is just a clearance sale for the disciplined investor. And mistake number 5 is thinking you need a massive amount of money to start. In the modern world, you can start with the price of a burrito. So what is the exact setup you should use? It's a simple blueprint. First, open a brokerage account with a reputable, low-fee provider. Second, choose a broad market index fund or a total market fund. You want something with an extremely low expense ratio. Third, set up an automatic contribution. Decide on an amount, even if it's small, that leaves your bank account the day after you get paid. Fourth, ignore the drama. Turn off the financial news. Stop looking at the red and green candles. Fifth, repeat this for years. That is literally it. People want there to be a secret formula or a complex algorithm, but the secret is just boring consistency. Wealth is not built in a sprint, it's built in a slow, steady walk that never stops. Rich folks recognize a psychological shift that the middle class overlooks. Wealth builds slowly, then quickly. First 10 or 15 years, your account balance may not be impressive. You'll feel stuck. Then interest earns interest. Gains start generating gains. Suddenly, your annual earnings exceed your contributions. Eventually, your annual income exceeds your pay. This is the turning point. Behavior matters more than intelligence in investing. Most folks desire fast cash to look prosperous now. Truly wealthy folks want ownership to get rich later. They know a car depreciates, but a stake in the 500 largest firms is productive. Your tiny decisions now shape your future self. I wish I had known at 18 that getting rich didn't require a genius or a stressful job. I had to trust the math and avoid my own path. A dollar invested now will grow into a tree that will shade you in 20 years. Even a dollar invested today is better than next year. In order to feel comfortable, procrastinators believe in the perfect time illusion. True growth occurs when you stay to a process regardless of how you feel. The simple investing method we've described is about preparation, not luck. You don't care which company triumphs when you dominate the market. Automating savings eliminates discipline issues. Long-term holders don't care about news. This is how you earn wealth while sleeping, traveling, and spending time with family. What age did you start investing, or what's stopping you? Is it market fear or a lack of starting capital? Discuss in the comments. Your journey to financial freedom begins when you invest your first $5. Stop waiting for the stars to align and build your future now.